Welcome to Trading Nation. I'm Courtney Reagan. There's a curious divergence happening in the markets right now. Take a look at the high yield bond ETF, the HYG, versus the S&P. Now, the two usually trade in tandem, but recently the HYG has taken a big leg lower. So how worried should investors be? Erin Gibbs is with S&P Global, and Craig Johnson is joining us today from Piper Jaffray. So Erin, ladies first, I'm going to start with you. This is kind of an interesting trend that we're seeing here. What do you make of it?
So what we see is really up until the end of February, investors just taking on more and more risk, piling into those high yield bonds. And then suddenly they've realized, oh wait, the Fed might just raise rates on March 15th, as well as increased concerns about a Frexit with the French presidential election. And I think those two issues are sort of the main factors that have really changed investors, where even though we're still seeing very low default rates, we don't have any predictions of them increasing, I think investors are starting to take some of the money off the table from some of the most risky assets like your high yields, and maybe be ready to put them in other areas in the upcoming weeks.
And Craig, what do you think? Does this trend that we're seeing here worry you at all? And what's your read on the situation?
You know, this particular trend in divergence does not concern me at this point in time. And the reason being is, before prior rate increases, in the chart that we brought in today, what I've shown is that typically the correlation between the SPX and the HYG are quite high. But as the probability of a rate increase begins to rise, we see a divergence begin to emerge. And that's exactly what we've seen happen in the past. That's exactly what we're seeing happening now. So I think this is really more of a short-term adjustment. And what we see is HYG starts acting like a bond, like it typically is, and you see that kind of quick sell-off. But it doesn't mean anything negative for the market, and typically looking forward, you see a pretty quick catch-up for the HYG moving forward after the event occurs, and you continue to see the S&P 500 go higher. So if we were seeing this kind of divergence in an environment where we weren't facing a rate increase or probability, that would be more concerning to me. But right now, I think this is just the high-yield bond market acting like a bond at this point in time.
Huh. And Erin, what do you think? Is this concerning to you to sort of wrap up the point, knowing what we know about the historical significance with the expectation for the Fed rate hike? Does that change anything?
No, and again, just like you said, we're looking at the default rates, and
right.
actually default rates are actually coming down, so we don't see any fundamental reason. The only thing is really the March 15th meeting coming up.
And I think those expectations, as you've both pointed out, are there, that we are going to get that imminent rate hike. So we'll see what happens in the subsequent months, because of course those then still become question marks. Thank you both so much for joining us, Craig and Erin, and thank you all for watching Trading Nation. I'm Courtney Reagan.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.